everybody joining us on the webinar this morning, all the business owners, the entrepreneurs, and especially our clients that have joined us. I believe we're supposed to have over 120 registered participants for this webinar this morning. My name is Monique Sharland, and I'm the founder and the CEO of Business Accounting Network, and which is a national franchise of accountants. And we are better known as BAN. And my background, I'm a professional accountant. I have some 35 years of working experience in the profession itself, and have specialized in micro, small and medium business tax law for just as long, which means probably that I'm giving my age away here, but I'm also a franchising expert, having founded BAN almost 20 years ago and have grown it nationally to what it is today. So that's my introduction to myself. I'd like you guys to introduce yourself. So Shane, I've got two polls just to understand our audience today and who is in fact listening. If you could please run the first poll.
Okay, so results of the first poll, we've got the majority, 41% have selected the last option, which is accountants and bookkeepers. So that's just over 4 out of every 10 attendees. And then the next favorite is a quarter, 25% are either in company or close corporation, that first option. And then we have even Stevens for the third option, sole proprietor, partnerships, individuals, trading in business, and individuals or employees. We just have a handful of folks, I suppose. I don't know what that translates to in numbers, but have selected the trustees of trusts. So back to you. Thanks, Monique.
Thank you very much for that, Shane. And if we can see those that are in business, the companies and the close corporations and the sole profs, if we can run the second poll, please, just so that we can get some kind of idea of the size of businesses that are listening in this morning. You're having a big smile on your faces right now when you see that, but it is actually quite a mistake. It's a mistake, one, in building an inefficient team because you think you're saving money. And another mistake is business owners who let their bookkeeping get behind because you don't think it's important enough, as the cost of accounting and business record keeping does not generate revenue. So you think that you can save costs just by ignoring your bookkeeping. Now you might think, why would this be the first mistake that I bring up? And it's because we as accountants see this mistake being made all the time, especially at the startup phase, because it takes 3 times longer to fix a mess, and it costs you as the business owner around 3 to 4 times more to fix it. Now, common sense is not that common, and you'll see this right throughout a lot of the mistakes we come across. So to give you some perspective on this problem that we have, not a day goes by without BAN's head office receiving either an email inquiry or a phone call asking, how much do your services cost? Well, which services? How complex are those services? Accountants can't provide a fixed price over a phone. The services we provide is nothing like going into Pick and Pay or Checkers and buying a commodity item. Now, determining the exact type of accounting to help your small business needs will determine the price you pay. So, for example, do you need bookkeeping? Do you need income tax? Or an accountant to provide specialist advice? The rates for each differ. The length of time required is different. So the total charges the small business pays will be reflective of the speciality chosen and the amount of work to be done. And every small business is different. One size certainly does not fit all. Ask yourself, would you phone around looking for the cheapest price for a medical doctor or a dentist or a surgeon? Is an accountant not also a highly trained specialist providing skilled services? So why would anyone think it's okay to phone around for prices for an accountant? And we see this all the time. The irony is that your business must be healthy enough to generate the money you need to pay for that medical doctor or dentist. And you need a good accountant to assist you and your business. Otherwise, how is your good business going to pay or get you there? Not hiring a good and experienced accountant, obviously, is at your peril. Always seeking out the cheapest methods to save business expenses can end up costing you more money in the long run. Just as you need a surgeon to remove an inflamed appendix, or you might need a lawyer to defend you if you are being sued, consider this. how are you going to pay for these services if your business cannot? So in essence, it is your business that generates the money you need to pay for these services. So why would a good experienced accountant to assist and advise you in your business not be essential? The old saying, you get what you pay for, and rubbish in, rubbish out, often holds true. And when the affordability is an issue in your business, that really is telling you there is a problem in your business, and it's time to actually invest in the professionals. So to avoid this mistake, spend a little extra, get quality work done, and peace of mind so that you can do what you do best in your business. What you should be asking your accountants. Now, these are mistakes I'm going to bring up before businesses even start trading. And this is a hugely common problem as well, and I'm sure that it doesn't apply to many of you, and that is choosing the wrong structure to conduct business in, and not understanding the owner's responsibilities. In other words, the laws that apply to that structure that you are trading in. And thirdly, that structure that you might have chosen, not having the funds to actually pay for the compliance of that structure. So many of our attendees this morning have probably been trading for some years now, and you're probably quite happy with the structure that you are trading in. And that is okay. But you are probably wondering why I would even mention this as a mistake. And one of the first mistakes mentioned in this webinar. Well, the reason for me bringing the mistake or choosing the wrong structure to trade in is probably the biggest headache and problem us as accountants to small business owners face. And that might include some of you listening right now. And if, after hearing me out, this does not apply to you because you are a near expert, say, on the Companies Act, then please pass this on to any friends or family that you might know that might be considering starting a business in the future or the near future. There's not a week that goes by where BAN's head office doesn't receive a phone call from a prospective client or business owner that's opened up a company to trade in when they should never have done so in the first place. Because the cost of compliance, as well as the statutory requirements of the Companies Act, far outweighs any benefits of trading rather in a sole proprietorship, especially for startups. So the mistake that business owners make is that many do not understand or know the full extent of their responsibilities and complexities and costs for actually being in the wrong structure to begin with, and not having the funds to pay for the compliance in that structure. I'm going to show you a picture, two pictures on the screen now, and this is really relative to companies not complying with the Companies Act. There are many criminal offences related to not complying correctly in the Companies Act, and one of them is that picture on the left-hand side. That picture on the left-hand side, I don't know, do anybody looking at it, do you know what that is? What are we looking at on the left? Do you know what we're looking at on the right-hand side? Now, as accountants to small companies, this is our biggest problem. You probably don't have either, and that's very often their problem. And if you don't, it's actually a criminal offence not to have. So the picture you're looking on the left is a shareholders register. It records all the shareholders. When they buy shares, they sell shares in your company. It lists the directors, your memorandum of incorporation, or otherwise your MOI, as well as a company register, which records all your resolutions in the company, your special resolutions in the company, and those special resolutions that need to be actually filed with CIPC. In the picture on the left, those two registers are in fact combined into one register. That is absolutely critical for every accountant to have access to before the financial statements can be prepared for a company. The same with the picture on the right. That is a share certificate, or an example of a share certificate. And that share certificate proves that you own the company and all the assets of the company. Now, without that share certificate, if you don't have one, you theoretically don't own your company or any of the assets that are in that company. So if a share certificate is lost, you've had one before and you've lost it, there's a process that needs to be followed in terms of the Companies Act to get a replacement a share certificate issued. So it's very, very important to know this and understand shareholders, which are owners of the company, are not registered anywhere else other than in the share register that you see on the left-hand side. That can also be a share register based in the cloud on software. That doesn't have to be a physical book like you see here. Therefore, if a shareholder does not have a share certificate on the right-hand side, they are not a shareholder of the company. They do not own the company or any portion thereof. And that is period. So I'm going to tell you a quick story about a really old lady, 73 odd years old. This happened about 2 weeks ago. And she was speaking to one of our accountants. And the most important thing to her was to be able to pass on some properties she owned to her children or to her daughter. And those properties are owned by a company. And it obviously generates rental income. So it's quite easy to trace exactly who owns the property, because you just need to go to the deeds office and see where the property is registered, in fact, and in this case, obviously a company. But now the question is, who owns the company? This old lady of 73 years old, all she wants is to make sure that her children or her daughter gets the property when she does not have a share certificate on the right, and does not have a company register. Never seen one, didn't know what it looks like, ever. Now, she's the sole shareholder of this company, so she says, and she's the sole director. If she had to die tomorrow, there would be a situation where the company owns the property and there will be conflict and embattlement right throughout the family as to who actually owns those shares, because there is no evidence of ownership of the company. So I'm sure you can all understand just how critical this is, and not having it, in fact, is in fact a criminal offense. So some of the mistakes that we also see that businesses make is that they don't understand the compliance costs of the structure that they are in. So just to give you some idea, a company versus a sole proprietor. Company has to comply with the Companies Act and the Income Tax Act. The Companies Act is quite onerous. Income Tax Act, it's pretty much straightforward. Sole proprietor, quite straightforward. Income Tax Act. But where the costs start coming in, the accounting records that have to be kept by a company differs substantially to that of a sole proprietor. So a sole proprietor, minimal documentation. You can just do an income statement on an Excel spreadsheet, make sure that your income and your expenses, you have got the supporting documents for it, and away you go. You don't even need a set of financial statements, unless, of course, you've got overdraft facilities or you've got some kind of financing. That does not work for a company. A company's got to have a balance sheet, income statement, cash flow projections, notes to the financial statements, and probably you're looking at a minimum of 20 pages for financial statements. Also, in terms of the Companies Act, more costs. Some companies have to comply with a different financial reporting standard. It is called IFRS for SME, or otherwise International Financial Reporting Standards for small and medium enterprises. And that means that the balance sheet and the actual trading of the company is looked at on a fair value basis rather than a historical cost basis. So in other words, if you look at a balance sheet of a company that complies with IFRS for SME, if you had to sell all those assets on the balance sheet and pay all the liabilities, you pretty much land up with exactly the monies in the bank. So, or the equity, should I say. Sole proprietor, historical cost base, tax base, simple as that. Then you've got the company register and the shareholders register, which is the pictures I've just shown you now. That's got to be maintained every single year. There are resolutions that every company needs to do at least once a year. Then, of course, there's share certificates that need to be issued and minutes taken at meetings. Even if you are the sole shareholder and director, you have to have a meeting with yourself, literally, around the boardroom table, and make board decisions with yourself. And that needs to be put into resolutions and then pasted in your company share register. Then, of course, there's also annual financial statements that the company has to produce, and it's got to comply with the Companies Act as well as the international accounting standards. And that doesn't apply to sole proprietors at all. Companies all have to do what we call a materiality assessment. In other words, the financial statements cannot be misleading, they cannot be fraudulent, they cannot be incorrect in any way, and the only way to ascertain that is to do what we call a materiality assessment. And that is what accountants do. That's not something, if you're not a trained accountant, you wouldn't probably know how to identify materiality. But these are all the extra work that goes into a company that you would never do with a sole proprietor, for example. And an accountant has to issue a report to a company when they compile the financial statements on behalf of you as the business owner. And that report is probably one of the most important aspects to the annual financial statements of a company. Some companies have to be independently reviewed. And that happens either because the structure is incorrect for a small business, or the structure might be correct. But what you're looking at is very high costs. An independent review is probably, the cost of that is probably 75% of a full-blown audit. The difference between a full-blown audit and an independent review is that auditors actually go to your premises and they go and make sure all the fixed assets are physically there, they can see it. They send letters to your customers to ensure that the amount of money that you say is owed to the company is in fact owed. Whereas an independent review is almost like a desk audit. So the independent review does not necessarily have to go and physically check anything unless it comes to his or her attention that they need to do so. So the costs there are obviously very high. Companies have to pay annual duties. That doesn't apply to sole proprietors. And then also companies have to submit what they call a financial accountability statement with those annual duties. That financial accountability statement is to declare that you have complied with the Companies Act, that your accounting records are up to date, they're not behind, and so on. And then CIPC can issue penalties for non-compliance. They can also, if you're a director, they can also, if you have quite a few non-compliance notices, they can also make you a delinquent director. And worst case scenario, CIPC can actually deregister your company if you are not compliant, which means that suddenly your business closes, the bank finds out as well, and you don't have a bank account anymore because they're going to foreclose on you as well. None of this applies to sole proprietors. So this is just to give you some idea of the compliance costs of a company versus sole proprietor and why your fees are so much more expensive running in a company. And first, getting some advice from your accountant as to whether you have in fact got the right structure that you're operating in. And even if you are in the wrong structure right now, your accountant can help you. So the solution before you go into business, or even if some of you are feeling, wow, you know, my costs for being in a company is too high, is it necessary? Go and speak to your accountant. Talk through your plans and goals with an experienced accountant because they can help assess your current situation and future plans to choose the right business structure that best fits you. And yes, your accountant can restructure your business by selling your trading business out of a company to a sole prop if you feel that the costs are too high. Right, the next mistakes we see, we spoke about startups and what we see in startups. Now we're going to look at mistakes that we see while in business. But first, we want you to ask yourself these questions. Why are you in business? Now, I guess most of you are saying, what a daft question. Money, of course. Okay, money, but what are you going to do with money? That's really the question. Are you in business just to put food on your table and a roof over your head, and to pay the bills, or maybe a holiday once in a while? We call that a lifestyle business. You can make money working for someone else too. You can be an employee and also have the same lifestyle, but less hours and obviously less stress than being in a business. So the question is, why are you in business? You can choose to carry on a lifestyle business as you might be doing right now, or you could ask yourself some hard-hitting questions. Can your business run without you? How much do you need to retire on? And can the sale of your business pay for your retirement? I can probably answer that. 99% of the time, the answer is no. So you need to set some SMART goals. Okay, they don't have to only be business-related goals. They should also include personal goals. But the important thing is you should be telling your accountant about them. Now, once you've written all your goals down and you've told your accountant about them, how is your business going to get you there? So this is one mistake that business owners make. They don't ask their accountant how they can achieve their goals and actually what those goals might be. So how to avoid this mistake? First of all, what you should be asking your accountant, but knowing this, failing to plan is planning to fail. So every destination obviously needs a roadmap. So what you should be asking your accountant is to help you with a financial plan to get to those dreams and those goals. Now, a financial plan is the same as forecasts or a budget, okay? They all mean the same thing. But a financial plan has a specific purpose in mind or specific purposes in mind. It's an estimate of future income, gross margins, overheads, net profits, cash flow projections, very important. Also done on a monthly basis, never on an annual basis. It needs to take into account seasonal months in your business, trends in your business, and obviously historical financial data and so on. You can't achieve your goals if your business is not making a profit. Simple as that. So the idea of a financial plan is a strategy to grow your net profit. And growing net profit is what business growth or growing a business means. It does not merely mean growing turnover. There's a lot more to it than just growing turnover. When you grow your business and you're growing your net profits, you've got to ask some more hard-hitting questions. And this has got to be incorporated in a financial plan. For example, does the business have capacity to grow sales? Do you have some grand marketing plans to grow sales? And what would the real cost of that be? How many additional employees would you need? And what would each of them do? Do you have big enough premises currently to take on more desks and chairs and computers and so on? Do you have those systems in place to grow? What about technology? All of this goes into the financial plan. Now, the estimates or projections in a financial plan should be for 3 to 5 years. It should never be less than 3 years. And remember, a plan is just that. It's adaptable. As things change, you adapt the plan accordingly. It's never cast in stone. Now, the cash flow projections are what's so critical here because they will determine how much funding your business will need to grow that net profit and in which month that funding should be sought. And it needs to be sought well ahead of the time it actually is needed. So a financial plan is usually a growth strategy or a plan to determine how much funding your business will require because growth requires funding. Okay, the next mistake we see is small business owners working in the dark, literally. Now, the question is, how would you measure this plan? How would you measure your business plan? Now, so you might say, why is this top of our list of business owner mistakes, working in the dark? Because many business owners don't think that they need figures on at least a monthly basis. When we ask a business owner, what is your tax that you need to pay for your provisional tax next month? They don't know. If you don't know what your provisional tax payment is due in the following month, it means you don't know what your taxable profit is. Very often we find that business owners say, well, I get financial statements, so I know where I am. Guys, financial statements happens once a year only. It's too late then. Or they say to us, oh, we've got the figures in our head, or I know what is going on. Now, for example, tax is to SARS or owing to SARS is a creditor, just like any of your other creditors. There's no difference between the two. And if you don't know how much tax you owe, that could be obviously a big cash flow problem. So we want to measure our plan. How are you measuring your current business performance at the moment? Are you measuring your current business performance? So what are we talking about here? We're talking about management accounts. Sometimes they're called interim financial reports or financial reports. We refer them as management accounts. Now, if you don't receive management accounts, can you make business financial decisions? So for instance, you want to buy a new car in your business, or you might need to buy more equipment, machinery, printing machinery, whatever the case might be. Can the business afford it? And without knowing where you are and you're working in the dark, there's no ways that you can possibly know whether the business can in fact afford it or not. Do you know how much tax you need to pay before your accountant tells you? Now, this is the kind of information you need to get from management accounts. So a mistake that we see small business owners make, they're working in the dark, is that they are also very scary. Those business owners are very scary to do business with as well, especially if you're the supplier or you're the creditor to that business. Okay, so how are you going to avoid it? By asking your accountant for monthly management accounts, also sometimes called financial reports, and let them discuss these results with you. Guys, it doesn't have to be monthly. It could be bi-monthly if you've got a very small business, and it could be quarterly if you're in a business, say, for example, if you're a medical doctor, you don't necessarily need it monthly or bi-monthly. Quarterly is just as good. The main thing is that you know where your tax position is. That is what is something that is so important for accountants to provide advice, because accountants cannot provide any advice without using complete and accurate management accounts. Accountants aren't psychic. I mean, we don't have a crystal ball. We are just as much in the dark as you are if you don't produce management accounts. So when you ask for advice and you don't have management accounts, it's pretty difficult for us to help you. Now, unlike annual financial statements, which is mainly for external stakeholders, management accounts generates reports for an organization's owners. And in general, the management accounts is the use of accounting information that will report on the recent historical trading and show the trading performance in relation to your financial plan or your budgets or your forecasts, to spot troubling trends before they spiral out of control, or to affirm if the business is on track. Management accounts can extend to risk management and contribute to identifying frameworks and practices for recognizing, measuring, managing, and reporting risks. So let's take a quick look at an example of a basic set of management accounts. There. This would be page 1 of the management accounts. This is a fictitious company, by the way. That would be your first page. The second page, you'll see who's been prepared by the qualifications of the person, the date it's prepared. That is in compliance with the Companies Act, Section 29. So it's very important that the management accounts also comply with the Companies Act, as this is in fact a company. This is probably the most important report that the accountant needs to look at, because they would do ratio analysis on this particular report. And this is the balance sheet or the statement of financial position. You'll see it looks completely different to annual financial statements. So here we have an example where we've got the current month we're reporting on, August 2019. We compare it to the prior month, and then we compare the prior year to the current year. It's separated between assets and shareholders' equity and liabilities. Non-current assets being assets that are held by the company for more than 12 months at a time. That would be your fixed assets, computer equipment, furniture, fixtures, fitting, machinery, etc. Current assets, trade receivables, these are assets that are held for less than 12 months. So trade receivables would be what your customers owe you. Other accounts receivable would be, say, for instance, deposits that you might have paid, and maybe prepaid expenses. And then cash resources is money in the bank. Shareholders' equity, very important. This is the equity that you need to have in your business in order to finance operating expenses. So here we have a shareholders' equity. It's made up in this case of retained income. So this company has obviously made some profits over time, and it's accumulated over time. Non-current liabilities, in this case, it's a loan by the shareholder. That loan by the shareholder actually finances assets minus liabilities. Every shareholder should have a loan in a company to finance its operations. Current liabilities, trade payables, which is what you owe your creditors. Other accounts payable, that is amounts that you would need to pay, like for instance, SARS, VAT, pay as you earn, those kinds of expenses. Provisions would be certain provisions that your accountant will put through just to bring in line certain expenses on a monthly basis. and bank overdraft and tax. Now that is the most important thing there, is the tax amount, that liability. So tip number 1 today is to take the tax amount that your accountant provides you every single month and go and open up a call account and put that aside. So when provisional tax comes, you've got the money to pay for your provisional taxes. So let's just have a look at how your accountant's going to calculate that. So we've got the statement of comprehensive income and retained earnings. To cut it short, this is an income statement without the expenses. So you've got a breakdown of the different types of income, and you show it every single month. And you can see a trend in those months. And that's very important, especially if you're a seasonal business. Here we've got less direct costs. This is because it's a service business, but if you are selling products, it will be cost of sales. And then we have a very important one here, which is your gross profit and your gross profit margins. We add on other income, things like interest and so on, which is not your operating income, minus your financing costs. And then we look at your net income before tax. This is the important thing. If you are not getting a tax provision from your accountant every single month, you are working in the dark because you don't know how much tax to put aside when provisional tax comes. All you've got to do is you've got to look at the year to date, and that's the amount you should have in a call account ready to pay your provisional tax. So you'll see that we have every single month the different the actual results, as well as the year to date, and then we compare it to the prior year to date. So under the prior year to date, it will be March 2018 to August 2018. Then this is a very important, obviously, is what your profits are before tax and after tax. Then we're looking at schedule of expenses. This is your overheads. Okay, they should be pretty consistent. These are your fixed costs, again, year to date costs, and you can compare to last year to date as well. And this is from your comparisons to your financial plan. You'll look at this month and year to date. Under actual will be actual this month. This will be your financial plan just for the month of August, the variance and the percentage variance. But it's not as useful as comparing it to year to date. Year to date is much more useful to compare it to. And then we also have the expenses. So you look at your forecast, your financial plan, compare it to actual for the month, and then year to date. As I said again, year to date is far more useful. Now, this is the most important report. One of the most important report, other than the balance sheet, is the cash flow statement that your accountant should prepare for you. Because this tells us where the profits have been spent. So if you've got no money in your bank, but you're making profit, your accountant can tell you where that profit went. Maybe it was to increase inventory, maybe you've increased sales and therefore customers owe you more. And they need to discuss this and sit down with you and explain exactly how this works. Once you've done this 3 or 4 times with your accountant and you continue getting the reports, you'll start being able to understand how to read a cash flow statement. So you can understand where your cash is going. And then, of course, notes to the financial statements. And these notes are nothing like your annual financial statement notes. These notes are absolutely purely for you as the business owner. So we would make certain notes in terms of balance sheet items and what they are made up of. And we would do exactly the same. Here we have a taxation note, exactly how we've calculated the tax. That's a very important note that you have in your management accounts. And then we look at certain fluctuations in the income statement. And if there's anything that we feel we need to bring to your attention, we will do that in the income statement. So that's pretty much what your notes would look like. Sorry, let's just get going here. Now you know what a set of management accounts should look like. Let's look at the next mistake that we see small business owners make. Using the business like a piggy bank. Now, business and personal expenses morphed into one bank account is a problem. It's a mistake. Over and above the fact it's costing you twice as much for accounting and bookkeeping, because now the bookkeeper is going to have to try and understand which is personal and which is business. You should separate your personal affairs, because your personal affairs are not your business affairs. Your business is a completely separate legal entity to you. You are just merely the custodian of the business and act in a fiduciary capacity to the business. And this is especially important to understand if you employ staff and you are VAT registered. So even if you are a sole proprietor, you need to have a separate bank account, one for your personal and one for your business. And you can see the picture there, living the champagne and cigar lifestyle. Another problem, another mistake we see a lot of small businesses make. Holding a view that any money in the business belongs to the business owner. I kid you not. Not understanding that every business requires funding from you, the business owner, to finance its operations and future capital equipment if you need to replace them. Not understanding that directors of a business are employees of that business. Even though you know and you think you are in fact the owner of the business, if you've got a company and you're the director and sole shareholder of that company is legally completely separate to you. You're an employee of your own company and you act in a fiduciary capacity to that company. So not understanding that a business is a separate legal entity to the business owner is a big mistake. Business owners are very happy to go and pay 900 Rand a month, say, for DSTV. But they're not happy to pay for management accounts or financial reports to monitor the health of the business and to identify risks before it's too late. It's crazy. Business owners who spend quite easily 500 Rand and upwards on spa treatments, but they won't invest in 1 hour's consultation with a professional accountant to obtain business advice. And they won't use their accountant to their full potential. That's a mistake a lot of small business owners make. And you might be asking, why am I harping on this? Well, because it causes a huge problem in your business. The first problem it causes, and these are real problems, is what we call negative liquidity. The second problem, which is disaster as well, is insolvency. And the third problem that this creates is what we call a contingent tax liability. So to avoid this, you need to understand the balance sheet that is produced by your accountant in the management accounts monthly. You've got to understand the liquidity of the business, and your accountant will obviously teach you that. The second thing, what is liquidity? Liquidity basically is, does the business have enough cash to pay its creditors on time? If it does not have enough cash to pay its creditors on time, we call that a negative liquidity. This is one of the major reasons why creditors will go and file for provisional liquidation of companies or trading entities. So it's a very serious matter. The second one is, of course, insolvency. And what is insolvency? Insolvency is when the liabilities of the entity exceed its assets. That's insolvency. So many of the small businesses have their head in the sand and they work in the dark. They don't know whether their business is liquid or not, and they don't know whether the business is insolvent or not until the accountant produces the financial statements a year later or a year and a half later, sometimes even 2 years later, and it's too late then. So let's just have a look at understanding the difference between a healthy business, a negative liquidity business, and an insolvent business. So here's a healthy business. Fixed assets, furniture, computer equipment, machinery, 200,000. You'll see if there was an asset account by a shareholder's loan, that would mean that the shareholder owes the company money rather than the company owing the shareholder, which would not be a good thing. Current assets would be your customers, what your customers owe you, as well as what the money in your bank. Liabilities, we have a retained income, which is part of equity, 25,000. These are profits that the company has made over time, and it has not distributed it as a dividend or paid it as a bonus to the shareholders yet. So it's sitting in the company. Shareholders loan account, very good. It's a liability. In other words, the company owes the shareholder 235,000. Current liabilities would be amounts payable to creditors or bank overdraft and so on. This is a healthy business because it is solvent and it's liquid. Now let me compare a negative liquidity situation. Same fixed assets, but look here, we've got a shareholders loan account where the shareholder, in fact, actually owes the company money. And we have current assets, which is the amount of say, customers and that owe money to the company, and money in the bank. So you'll see that this is decreased because the shareholder has taken up more money than the company can afford. However, we're looking at a liquidity situation, but there is a retained income here of 75,000, which is equity to the shareholder. So if we had to distribute this retained income to the shareholder, we'd pretty much wipe out the loan account And we would actually get the situation under control in that we could actually make this particular company liquid again. And then current liabilities is monies that are owed to creditors, as well as maybe to bank overdrafts and that sort of thing. So basically, the assets are 375,000. Let's say that the fixed assets, well, you're not going to be selling that for resale, so that stays. Furniture, fixtures, and fittings. And let's say that that is actually the market value of those assets as well. Our assets, the money that's in the bank and the money that our customers owe, is less than what we owe creditors. This is what we call a negative liquidity situation. And this can put a business under. Insolvency, there's 200,000, same with the fixed assets. We have the shareholders loan account again. We have the same amount in the bank, but now we don't have any reserves. So basically, this shareholder has taken more money out of the bank. And where's he taken it from? He's taken it from current liabilities. So in other words, he's basically getting his creditors to finance his lifestyle here. This is an insolvent situation. And it's obviously disastrous for any small business. Obviously, we see this often because businesses are working in the dark, they're not getting management accounts, and all this comes from your balance sheet. Right, another mistake, businesses pay more attention to getting sales or saving on expenses, but not enough attention on getting more profitable. So if you sell something, does that mean you are profitable? Now the question is profit before you take a market-related salary or after you take a market-related salary? Many business owners think that money in the bank is for the taking. In other words, it's their salary, so they just wipe it out. Do you know what salary your business can afford to pay you? What do you need to pay when you draw a salary? PAYE. If you are not paying PAYE on the months you draw out of your business, you're not drawing a salary. You're drawing money literally straight out of the company. Now, tip number 2, should I say, open up a call account linked to your business bank account and squirrel away money every month, the amount as per what your accountant has calculated on your management account, so that you can actually pay your income tax and your VAT and any other annual expenses such as bonuses to your staff. Okay, so let's look at this scenario. This is management accounts. We're looking at sales and we're focusing on increasing sales and not on profits. So our sales in the month 1 is 100,000, giving us a nice gross profit of 60,000. Look, we are really targeting our sales 150,000, following month 200,000. We're really focusing on sales. We're doing well. Gross profit is also increasing. Now we look at expenses, which obviously includes the owner's salary, as I mentioned before. And we're looking at a net profit in September, 30,000. Our expenses have increased simply because our sales have increased, so there would probably be some kind of a connection there. But look what's happening to our net profit. It's going down. And look in November, it's gone down even more. So this is what we mean when we are focusing too much on sales and the increase of sales, but we're not focusing enough on this bottom line, net profit. Gross profit percentage, your accountant will work that out for you. So now, if we peg at September, we achieved a gross profit percentage of 60% and 45% in October. So here's your gross profit, 60,000. It's 60% of sales. Gross profit, 67,500, 45% of sales. And gross profit, 70,000, 35%. So you can see that the margins are going down, down, down. Do you notice that when we do the margins, the gross profit is before expenses? I'm sure most of you zoomed in and said, oh gosh, look at the expenses, they're increasing too much. That's the problem. It's not the problem, because the ratio tells us it's above the line of expenses. The problem is sitting here. And most of you will say, but look at the cost of sales, which is either salaries if you are in service industry or products. They will all zoom in on this and say, well, that's too high. Well, that's not often the case. The problem is the sales itself can very often be the case. And the reason why sales can be the problem we're going to look at another slide and see what the mistakes are that are made by business owners. So we can zoom in either on sales or cost of sales, but the problem lies in one of those two accounts. Now, if we had to maintain a 60% gross profit, which we did in September, look what happens to the net profit. So from 30,000, we saw 30,000. 27,500, now we maintain a 60% gross profit. Look at that. Our profit now is 50,000 instead of 27,500. And then in November, instead of 20,000 Rand profit, we focused on our margins and we've achieved a 70,000 Rand profit. It makes a huge difference. This needs to be monitored every month in your management accounts. Let your accountant advise. Okay, these are the problems and some of the issues that could have made the gross margins decrease instead of staying in line at 60%. First of all, check your selling price. When last did you check your selling price? Have you costed in all your overheads in your selling price, especially annual overheads? And have you costed in profit in your selling price? Are you giving away discounts that you cannot afford? Know what gross margins you need to maintain. Know what each customer's cash flow percentage is. Which customers are profitable, which customers are not. Know what products or services generate the highest return on investment. Let your accountant investigate that problem. And then they can find a solution and a strategy to get around it. Now, the next mistake is not taking into account annual expenses and profit when costing products and services. And if you don't take in all your annual expenses and product, you're going to land up like this picture on the right-hand side. Lose money fast. Ask me how. And another mistake, I think that little picture can probably tell you what it is, giving discounts away when not costed into selling price. You see this mistake often in with small business owners. So how do you avoid it? Know your business's break even by using annual overheads. That means you're going to pay your accountant once a year to prepare annual financial statements. That cost must be costed into your selling price of your goods and services so that you can afford to pay your accountant for the annual financial statements. Again, you might pay your staff bonuses once a year. That needs to be costed into your selling price. So, a tip here is to put that money aside for annual expenses into a call account. So now you've got a tax call account. Now you're going to open up a bonus call account and squirrel away some money every single month so that you can afford to pay your bonuses. Especially, I'm sure most of you, it's December now and all worrying how you're going to pay any bonuses this month. Well, if you squirreled away every single month some money into a call account, from your operating account, you would easily be able to pay your bonuses. Another one, say for instance, is workman's compensation. That's also paid annually. So make sure that you put away something every single month so that when you get that bill in March next year for your workman's compensation, you've got the money to pay for it. So your annual overheads, these are the kind of expenses you don't think about when you do your costings on your products. And when you work out your break even. So what is break even? Break even means the amount of turnover you need to achieve every month that's going to cover your cost of sales. In other words, either if you're in the service industry, your salary staff that generates an income, or if you sell products, your suppliers for those products, plus your overheads, which includes your annual overheads. Add profit on top of that to provide a return of no less than the CPI index, plus 5% or more. 5% is a bit little, but 5% or more. Because your net profit is your actual return on investment in your business. And remembering that your business is a high risk, as opposed to putting that same investment into a bank and generating interest. So you need a higher return. You also need a higher net profit return in order to replace fixed assets and, more importantly, to grow a business and add some value to the business. When last did you review your selling prices and your pricing strategy? Now, that could also be a problem in the previous slide, is that your selling prices are, and we've come across this as a big mistake that we have found, where we have come across people that have imported goods and they have not costed the selling price correctly, that in fact they have sold below the actual landed cost of those goods. Crazy, I know. That's why it's so important to review your selling price. You've got to also understand what market you fall in when you look at the pricing. Are you in a cost-based pricing market, like a manufacturer, or you provide services? Are you in a competition-based pricing market, which I don't think many of you are? That's your pick and pays and your checkers. Those are your big boys. Or are you in a customer-based pricing market, which is your sort of on-trend kind of top-end market? Right, next mistake we look at is not knowing the difference between profit and cash flow. And we see this quite often. So business owners use VAT, literally, and income tax as cash flow. And by doing that, guys, if you're not paying your VAT, if you're not paying your income tax, you're actually trading into insolvency. Right, so some of the business owners honestly think that SARS is stupid. Just because you haven't been caught yet does not mean SARS is stupid and you won't get caught. Businesses that use VAT as their cash flow are invariably trading with a negative liquidity, or could even be trading insolvently. And we've seen business owners who have used VAT for their own personal use. In other words, they take it out as if it was their salary. And because they have no idea how much of the money in their bank account is VAT, as a business owner, one must be reminded that you act in a fiduciary capacity. You collect VAT from your customers on behalf of SARS. That VAT was not your money to begin with. And if you are using VAT or income tax to trade, this would constitute reckless trading. Directors, personally, taxpayers personally, will be held responsible for outstanding taxes. That means that even though you're in a company and you think you're protected in a company, you're actually not, because the income tax laws say that they can actually attach your personal assets, your house, your car, your furniture, to pay taxes. And also, of course, it's a criminal offense, and they might institute criminal charges as well. So what is cash flow? Cash flow is a timing difference between the date you pay for products, literally out of the bank, or inventory, and it's for resale, or you pay salaries if you've got a service industry, to income generating employees. And the date you actually receive the money in your bank account when your customer pays you for those products or services sold. That is what cash flow is, a timing difference between those two payments and receipt of payments. So what is profit? Profit is a net of sales, even though you have not received payment yet, less cost of sales. Now, cost of sales, if you're selling products, that would be for resale. Even if you have not paid for those products yet, that will be cost of sales. Or if you're in the service industry, it will be the salaries that you pay your employees for services rendered, but you have not necessarily paid your employees by that stage. Well, hopefully you have. And less expenses, or what we call overheads. That's your accounting fees, your bank charges, your rent, your telephone, etc. Even though you might not have paid some of those expenses yet, say, for example, your rent or your telephone. That is what is profit. So you can see the one is actual physical cash in and out the bank. Profit is not necessarily in or out. So how to avoid the problem of insufficient profits or negative cash flow? Management accounts will immediately identify what the real problem is, which we've seen in the previous example. Now, more often than not, a problem in a small business is not cash flow. Small businesses will always use, I've got a cash flow problem. And 90% of the time, it is not. Especially if they can't pay their VAT. Well, sometimes it might be because you might have a customer who owes you a significant amount of money, who has not paid, and therefore you are short in cash to pay your VAT at the end of that month. So for that reason, maybe. It could also be that your break-even is not being met. You simply are not making enough sales to meet overheads. Or your costing of your products or services is incorrect and does not include annual expenses, profit that we spoke about earlier, or replacement of assets that you need to buy. Or your margins are too low. Therefore, your sales need to be considerably higher. Or you are giving away too many discounts without costing it into selling price. or you have not got an emergency slush fund for emergencies, or you are selling more products or services to non-profitable customers, you can ask your accountant how you test whether a customer is profitable or not. You are buying products or paying staff that are not profitable. Again, you can ask your accountant how to assess each product or each staff member, how profitable they are. But really, very rarely is it expenses being too high. Guys, I've been in this game for small businesses for 35 years plus, and I have yet in 35 years seen a business owner in a small business that is spending too much on expenses. If anything, they underspend, not overspend. They underspend, especially where it's needed the most in a business. For example, marketing. For example, paying a good lawyer or a labor lawyer for advice, to pay their accountants for advice, to pay specialist consultants. They underspend. Where they do sometimes, where we do see the problem sometimes, is that you're drawing more money out of the business than what the business can afford. So invariably, very often, it's not a cash flow problem. So you need to work with your accountant to identify the problem and develop a strategy to turn it around. Now, not every business can be turned around. Sometimes there might be a very harsh reality that the business needs to close. But please do speak to your accountant. There might be other avenues. However, one of my greatest things in life to punt is using a business coach, a good business coach with your accountant to turn that business around. And I can't rate business coaching higher enough. Right, the next mistake we see, and this one we're going to have to read 2 or 3 times for you to understand it. And this is when it comes to growing a business. You cannot grow a business to make money for yourself if the business's investment in assets, which is customers, amounts receivable, and inventory, increases at a faster rate than the business's net profit. Okay, so let's try that again. You cannot grow a business to make money for yourself if the business's investment in assets, which is customers and inventory, that's all the only assets we're looking at here, increases at a faster rate than the business's net profit. So let's look at what we mean. We've got 3 financial years, 17, 18, 19. Look at the net profit. Wonderful. Started off at 90,000 in 2017, up to 120,000 in 2019. Is that good or bad? I'm sure you're all saying that's great. It is. Now look at the total assets. Okay, the total assets being what your customers owe you plus inventory. 100,000, 250 up to 220, 220,000 up to 390,000. Fine. That is absolutely acceptable. Simply because if you're going to increase profits, it means you're selling more to customers, which means more customers will owe you, which means that you've got to buy more inventory or you've got to pay more staff to deliver the service. And so your inventory or your work in progress will also increase. So that's completely understandable. Now your accountant comes along and does a return on investment ratio. And they say, whoa, there's a problem here on your balance sheet. Okay, we had a return on investment on assets of 90% in 2017. And look at this, whoosh, it's gone down to 31% in 2019. That is a big red flag. Now, usually we would do this in management accounts and pick this up in management accounts, not 3 years later, because 3 years later could be too late. Because let me show you what that ratio tells an accountant. Increase in assets, so from 100,250 Rand to 220,500 is an increase in assets of 120,250. From 220,500 to 390,000, we've increased our assets by 169,940. Now we're talking about assets. That's a good thing to have in a company or a business, isn't it? Sure it is, absolutely. But let's see what happens here when we grow too fast. Our profit in 2017 was 90,000. Our profit is less than the increase of our assets. Okay, the following year, our assets increased more than the profit we earned in 2018. That means we have a cash shortfall. investment shortfall of, in the first year, 32,000, because the profit cannot finance that increase in assets. It cannot finance those customers that have not paid. It cannot finance the extra inventory you've had to purchase to grow your business and your turnover to increase the profit. Where is this money going to come from? Now, the following year, exactly the same thing happens. 59,000, almost 60,000 rand short. But here is the real problem. It's accumulated. So in year one, we've got 32,000 shortfall of cash. Where's this going to come from? So you're probably not going to pay your creditors on time. And then SARS back payments are neglected. So SARS doesn't get paid. Look at the following year. It actually adds on it's an accumulative amount. So it adds on the 59,000. Now we're sitting at 92,000 rand cash shortfall. And if this continues for the next year and the next year, we call this a death spiral. A death spiral means that this company will go into provisional liquidation very quickly because the creditors will put it into provisional liquidation. Or what you can do to avoid the problem, use your accountant's full potential. Let them pick up the problem to start off with. And know this before you even start. When you grow a business, growth requires funding. You can either what we call bootstrap growth. That means you use the profit in the business and only the profit, not more than the profit, to grow. But remember that profit also has to pay liabilities on your balance sheet. So if you have an installment sale, for example, on your balance sheet, the profit has to pay that as well. Okay? So profit is not all the cash that's left over. It's also to reduce liabilities. Or you can borrow money from family or friends, or go to the bank, or find an investor and give away some equity in your business. Or you can refinance assets in your business. Now, of course, that doesn't work for service businesses. That's more if you've got the type of nature of business that can refinance assets, for instance, manufacturing, printing industries, that sort of thing, then you can do that. You can also consider factoring debtors, although that's something I probably wouldn't highly recommend, but that's another story in its own. Or you can win the lottery, or marry rich, or inherit from a rich relative. But use your accountant's full potential and learn how to financially manage your business better. I'm going to show you how you can grow your business without having to win the lottery. And this is one of my last slides. We will be open for questions shortly. So let's take an existing business that's doing 3 million turnover, and we want to grow that business by 20% to 3.6 million. That's our projection. Because we want to meet the financial plan to increase our net profits so we can achieve our goals in our personal capacity through our business. So here's a plan. Your accountant will work out how many inventory days your business has. In other words, how long does it take you to hold stock before you invoice it? If you're a service business, say in the accounting or the law profession, how long does it take you to actually bill your clients from the work in progress that your staff have created for that particular client? That's inventory days. Your accountant will calculate that. Then they will calculate customer receivable days. How long does it take on average for your customers to pay you? So here we've got 50 days. That's not very good if you've got 50-day terms with your customers. So that's not a very good reflection. And then we say, okay, how long does it take for you to pay your creditors? So let's say most of your terms are 30 days with your creditors, which is very good. We've got 30 days. This will then equal what we call a total cash cycle days. Here we've got 110 cash cycle days. Your accountant will work this out for you. If you've got 110 cash cycle days and you're doing 3 million rand turnover, that means you, the business owner, would have to have a loan account to your business of a minimum of 904,000 rand. Otherwise, this business can't operate. It will be insolvent. If you want to grow your business to 3.6 million, that means that you're going to have to put in additional funding of 180,000 into your business in order to grow the turnover by 3.6 million, using exactly the same amount of total cash cycle days. Now let's have a look and see what your accountant can do for you. Let's say we're still on track 20% growth, 3.6 million rand projected sales, but now we work on inventory days. We are going to reduce the amount of time that you hold inventory for. So you're going to turn it over faster and you're going to hold far less. So you're going to invoice your customers quicker. Then we're going to talk to all our customers and say, a gentle reminder, everyone, you owe money and you've only got 30 days and you are 5 days late. So let's say we bring down the customer receivables from 50 to 40 days. We do not mess with creditors. If your terms are 30 days, you pay your creditors in 30 days. Just as much as you want your customers to pay you in the time that they've agreed to pay you, you can't mess with your creditors. They are not the bank. Okay, so we leave that at 30 days, but we bring down our total cash cycle days from 110 to 80 days. The financing you, the business owner, would need to have in that business to finance 3.6 million on an 80-day cash cycle. Look at that, 789,000. It's less than your 3 million rand turnover. So not only have you achieved 20% growth, you have also found extra 115,000 rand in your business, cash. You've achieved the growth and you've also achieved more money in your business. Isn't that fantastic? Okay, guys, that is pretty much coming to the end of our webinar today. So if you've missed any information on today's webinar, we'll be uploading the recording onto our website, which is www.ban.co.za. You'll just need to click on the events tab and click on the icon called free webinars. We'll hopefully maybe upload this recording by the end of today, tomorrow latest, I'm sure. Our next complimentary business webinars will commence next year in February. So keep a lookout for your emails and also on social media. And I'd like to take this opportunity to wish all of our clients and our franchisees and our alliance partners a wonderful festive season. Enjoy, relax, re-energize for next year, and keep safe. We look very forward to seeing you all again in February. Ban's head office will be closed, by the way, from the 20th of December, and we shall be reopening on the 6th of January.